in 2021, people was talking about like software is eating the world. And this
Yeah,
year, again,
right.
people are talking like AI is eating software. So
Yeah.
you
That's
can just
great.
like,
I love that.
1, 2, 3, 4. All opinions expressed by Chris, Michael, Zach, and their castmates are solely their own opinions and do not reflect the opinion of 5i Research. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 6th episode of The Exponent with 5i Research. My name is Chris. I'm a senior investment analyst with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. Today, I'm joined by my co-host, Michael. Welcome, Michael.
Hey, Chris, how's it going?
Yeah, not too bad. Can't complain. The markets are closed today, so that's always tough to just kind of sit idly and not watch the markets move. But it's been a while since we've last done an episode. Since we've done an episode last time, the markets have been ripping higher over the past couple of months. But the Canadian markets have pretty much been flat. We've seen a lot of strength in the U.S. markets coming from a few mega cap tech names, as we all know. But with the Bank of Canada cutting rates, we didn't really see any sort of market reaction from Canada. But we did see Canadian bond yields. They've been falling a lot since Canada cut rates. And that's going to be a welcome development for future borrowers. But really the TSX has mostly been trading sideways. We've had some good inflation and economic data coming out of the US. And so there's a lot to digest there. But what I'm finding really interesting is that the breadth of the market right now. So we're seeing the equal weight NASDAQ and S&P 500. They're actually still just at their previous all-time highs from 2021, while the market weighted indices are up about 15 to 20% above their highs from 2021. So, I know there's a lot to unpack here, but, what are your thoughts on all of this? What kind of, how are you feeling about the markets in general and just the divergence between the Canadian and US markets?
Yeah, sure. So, the market is basically like while the S&P is like getting to like new all-time highs every day, but some corners of the market are not performing that well. Like, software, healthcare, some of that we will talk about it today. And surely there feels like a huge divergence from like Canadian and US market, especially like small cap Canadian. People are speculating some of it because of the capital tax gain change this year. But I don't know.
Yeah. That's totally, those are all really good points. And it's especially true what you mentioned about, corners of the market really not participating in this rally. And I think that's kind of really leading to this wide divergence. But with that said, can you take us through kind of the agenda for today, I guess?
Sure. So today we're going to talk about a few topics like are we in a global interest rate cutting cycle, some Canadian small caps that you and I like as usual, and the research on stock performance following like big one-day gains, and also like what's been working and what hasn't working this year. Also a few highlights from the first quarter earnings of companies that we follow. So that's pretty much it.
Definitely. Nice. So that's a good overview. Let's start into the are we in a global interest rate cutting cycle kind of piece. So I'm going to add a chart to the stage here. So this is a research piece that I've done on kind of the G7 nations and key policy rates. So Canada's been the first of the G7 nations to cut its key policy rate. It cut from 5% down to 4.75%, so 25 basis points. And globally, we've seen some other countries starting to cut. So this research piece, what I've done here is I've stacked interest rates from all of the different G7 nations since 2003. And what we can see, like, largely is that they move in tandem. They move with each other. And it's pretty clear that with the Bank of Canada cutting, the Federal Reserve is signaling they're going to cut. It's pretty clear that we're at peak policy rate here. Now, the question is, how fast and how much do we all drop together, all of the G7 nations? How much does that come down globally? But we kind of have a pretty good indication that this is largely going to be the peak for interest rates, unless something, barring some sort of crazy reinflation event. But from the data that we're seeing, we're really not kind of getting any indication of that. But, this is really going to be like a lowering of the interest rates, which is going to be good for revitalizing the economy. But it's going to be important to see how that unfolds too, because, sometimes unwinding of the interest rates, global interest rates, has been just a normalization for economies, and it's been quite positive. And we've seen economies kind of go through that with continued strength. And other times it's kind of been the opposite. So we won't really know until we're kind of going through it and getting more economic data points. But for now, this is kind of all that we have to work with, is that, we're pretty much at peak policy rates here. Now, the next slide that I have here, what I've done here is this is just a chart of Canadian interest rates since 1990. And we can see that, even though the Bank of Canada has signaled that rates will come down slowly, and then we're going to be data dependent, what's interesting to me is, historically looking at it, interest rates have almost never come down slowly. So typically they come down in a fast and pretty precipitous kind of manner. And, it could take maybe 1 to 2 years, but some of these rate drops have been really quite dramatic. And so the other piece that I've done on this chart is I've overlaid the forward 1-year return for the TSX at each instance when the Bank of Canada started to drop rates. So for example, 1991, when the Bank of Canada started dropping rates, the forward 1-year return for the TSX was just about flat, minus 2%. Now, next to 1995, when Canada dropped rates again, the forward 1-year return for the TSX was positive 18%. And then so on and so forth as we kind of go through the different rate cutting cycles. And so we can see that, no one rate cutting cycle is like the other. And this is different from other research that I've done on, what happens when we pause interest rates and when we increase them. Those are more or less, they're like, they've historically been pretty similar in terms of returns and positivity. But here it's kind of a mixed bag. And so we don't really know what we're going to be seeing in the forward 1-year return for the TSX, but we can see historically it's definitely been a mixed bag. Now, the other piece that I've done is I've looked at, in that table on the graph, I've looked at the forward 1-year return for the TSX, as well as the forward 3-year annualized return for the TSX at each instance that we start cutting rates. And what I found really interesting is if the first year of the TSX for a rate cutting cycle is positive, usually the forward 3-year return is also quite positive, and there's a strong annualized return for the 3-year period following. Now, conversely, that's true as well when the first year is negative. The forward 3-year period is also pretty flat and not as positive. And so really, this is kind of signaling there's 2 types of rate cutting cycles. There's, let's normalize the economy, bring it back down to, to healthy levels and just kind of keep inflation at bay, but also revitalize the economy. And then there's kind of panic cuts where the economy starts deteriorating fast and rates need to be cut because of some sort of economic dire sort of situation. So like I said, we don't know which one we'll be going into, But this is kind of the data that we have to work with. And so, yeah, so this is the research piece that I put out for members.
Nice. Yeah, totally. I hear you on this. It seems like we've done pretty much done with this like interest rate cycle and would likely start like a new one like starting this year. And you mentioned like there's always a risk that inflation could come back up and all that stuff. But if you look at like the real economy rather than just like on the figures, people are getting like desperate enough. People are spending less on like large ticket items, less on cars, eating out less, etc. Yeah, and although we don't know like how many rate cuts there will be this year, but the trend of declining interest rates is certainly favorable, especially like for risky assets like small caps and then industries with leverage balance sheets and stuff like that, like real estate, utilities. Those sectors could perform decently in a declining interest rates environment.
Yeah, no, definitely. That's an excellent point too, is that, although the TSX as a whole kind of can see positive or negative returns, individually, different names and sectors, industries can see kind of varying different types and styles of returns in, different rate hiking or cutting cycles. So yeah, like you mentioned with rate cuts, there's certain sectors and industries and over leveraged names that are going to benefit. And so that's going to be huge for investors to pick up on that and kind of, maybe take a look at an investor's portfolio and say, are there some names that I can benefit from a rate cutting cycle? So yeah, it's a really excellent point. Thanks for that. So our next section is always our favorite one here. So we've got Canadian small cap names. So Michael, why don't you lead us off with your small cap name here?
Yeah, sure. So today I'm going to talk about like a pretty much like under the radar small cap name, which has come under my radar recently, mostly because of like the solid momentum and also some macro theme behind it. This name would likely be like a winner in a favorable rate environments. So today I'm pitching like Taiga Building Products. The ticker is TBL, and the company operates as a wholesale distributor of building products in North America, like engineering, wood products, decking, roofing materials, etc. And the company has a market cap of 419 million. And as I mentioned, TBL experienced solid momentum recently, with the business demand expected to be like favorable in an upcycle over the next few years. And the business is still like quite under the radar. And although the company operates in a very cyclical industry, because the demand for building products is pretty sensitive to macro environments like consumer spending, interest rates, etc. But the underlying business is quite attractive. So so in the last 5 years, TBL EBIT growth was around 10% on average, even though it's lumpy year over year. And the company is now just trading at like 6.9 times trailing PEs. The reason I don't use forward PE is because no one covers it, so I don't have that. And the business. So despite the cyclicality, the business generates very healthy cash flow over the years, with very limited needs for capex, and so a very healthy free cash flow profile. And the balance sheet is also strong, like very little debt. And the companies generate lots of cash over the years, and historically they chose to pay special dividends. So in the last 3 years, they paid special dividends twice, once in 21 and the other in last year. So very attractive dividend yield here. And with this setup and this momentum in this kind of environment, I think the share price could continue to outperform over the next few years as the demand for the business pick up from here. So that's pretty much my pick for this time. What is yours, Chris?
Nice. Yeah. No, yeah, and just on TBL here, I mean, just looking at it kind of over on some of my screens, it looks really good. I mean, momentum's looking solid. Like you said, it's trading at a cheap valuation, and it could see a lot of demand for home building and other kind of projects like that, and some of the roofing and things like that. So, really solid looking name there, totally under the radar. Not one that I've seen a lot of questions or anything else on. And that's always great when those are kind of brought to the forefront. So we get to see a variety of different names, and especially one that has, special dividends, buybacks, and other kind of aspects like that. Really returning a lot of capital to shareholders. So always nice to see that. Awesome. So yeah, I'm going to pull up my name here. So my name is Celestica for the Canadian small cap name segment. The ticker is CLS. So really, this is a name that benefited from the dot-com era boom. So in 2000, it went up massively, but also in 2000, it dropped. And I think it was a drawdown of like 90+%, pretty significant. And then, the name kind of just traded sideways for, the next like 20 years, really. Sales were flat. They had issues with profitability, cost management. There was lots of fluctuation in the sales and profits of the company. But what we've seen now is really a significant change in course from the company since 2023, as it's massively benefiting from AI, machine learning, compute, all of this demand that's coming from the hyperscalers. And for listeners that aren't aware, the hyperscalers being mostly, the mega cap tech names like Google, Microsoft, all of those cloud computing kind of mega names. And, so Celestica is a tech manufacturer. It's engaged in the design and engineering of electronic components. And really what I'm showing on this chart here, or this slide here, is, it operates out of two segments. The first is called ATS. That's Advanced Technology Solutions. This is more catered for its like aerospace, industrial, healthcare sectors. And then DCS is its second segment, and that's connectivity and cloud solutions. So this is more so for its AI compute, networking, and other sort of sectors. And so that's where that demand from the hyperscalers is really coming from. And so we can see, against last year in these two pie charts, we can see against last year, sales and profits from its CCS segment are really becoming a much larger percentage of its overall business as demand from these hyperscalers ramp up. So for example, Q1 2024 revenue, we can see 65% is coming from CCS, whereas in the previous year, it was 57%. And the same sort of trend with its net profits there. A much larger piece of its overall business is just coming from AI demand. Now for 2024, it's expecting a slight decrease in its ATS segment. So that's kind of like its healthcare industrial segment. But it's expecting a mid-40s increase in its communication segment and a low 20s increase in its enterprise segment. And both of these segments are showing improved margins. And so those are, really strong, really impressive numbers there coming from those two sections. And that's mostly due to AI demand for both AI and machine learning. And so really it's just kind of in the right place at the right time, where it operates in a niche market that is benefiting from all of this demand from hyperscalers, and extremely strong forward guidance on both sales and profits. And so overall, this is fundamentally, it's a company it's doing quite well. It trades at a cheap valuation of 18 times forward earnings. It has a 3% buyback yield right now. And like I said, it's expecting to grow fast. And then here we can just see different, return metrics for the company. So we can see that, kind of sometime in 2023, we saw this inflection point where really things started to take off for the company. Investors, caught wind of that. And then that's why this name has been performing so well. And even though performance has been excellent, for a company that's expecting to grow about 20+% next year, it still trades at, 18 times forward earnings, which is much cheaper than some of the US counterparts. So really interesting, like small cap tech name in Canada that's benefiting from AI. And yeah, I think we could maybe continue to see this name kind of outperform here.
Yeah, I agree with you. The momentum is solid.
Yeah,
and yeah, we've been a big fan of CLS. Like recently, is in our growth model portfolio. Yeah, so as you mentioned, is AI kind of play. Very pretty cheap, like trading like 18 times for PE. This buybacks and double digits growth over the next few years. So pretty neat and simple story there. Yeah, I think even though like the charts look like it's a hockey stick, but
yeah,
it's still not that expensive, and people tend
right.
to like underestimate like how much like long term demand like AI could have on the company could enjoy from here.
Yeah, no, definitely. Yeah, it's looking like pretty much an Nvidia, like, SMCI, like all of those mega caps, or even just the semiconductor name. So even though it's not really a semiconductor name, it's benefiting in a way that is kind of unique as well. So yeah, definitely an interesting name. Yeah. Okay. So next, the next section is one I'll just be talking about mainly here, but Michael, feel free to join in and kind of, join in on the conversation. But this is a research piece that I've done for members, and it's looking at, kind of single day gains and what happens to stocks following these big 1-day gains. And so what this chart analyzes here is this is looking at the total frequency of single day gains for, mid caps, large caps, and small caps in the US since 1980. And so what we can see is, for example, on the left side, the very far left 3 bars there, that's looking at the total frequency of single day gains between 0 to 5%. And so really, naturally, it makes sense that that's the largest bar because we often see stocks move up between 0 to 5%. Now, conversely, on the other side, the far right-hand side, we're looking at stocks that, have gone up 95 to 100% in one day, which is quite rare. And that's why, really the only stocks we see doing that on the far right side are the orange bars, and that's small caps. So what we're showing is that, as we get larger and larger single day gains, they're mostly coming from small cap names, which intuitively makes sense. A Microsoft isn't going to go up 100% in a day, most likely, but some $500 million company could, and so that's kind of what this chart is telling us. But now we want to look at what are the forward returns like for stocks that see these sorts of single day gains, and what are the quality of these names. So that's why on this next slide, what I've done is I've looked at the forward 1-year returns at these different single day gains. So we can see that, really for stocks that can see a 0 to a 40% single day gain, the forward 1-year returns in those names have historically been pretty increasingly attractive. So, the higher the single day gain, the forward 1-year return on average has been better for those names and pretty attractive. But beyond a single day gain of 45 to 50%, the forward 1-year returns start to get a little bit mixed. So, sometimes they're really positive, sometimes they're even negative. And so that kind of signals that, if there's a stock that goes up 60% in one day, it's quite possible that the next year, it's down from where it was that day. And so oftentimes those names that are going up, 60 plus percent, it's often on one piece of news or just like an approval of one of their trials, if it's a biotech name or something weird like that. And usually it kind of signals that, what this chart is telling us is that the quality of those names that see, big single day gains, the quality starts to diminish beyond like a 40% single day gain. And so no real surprise there. I mean, when we look at something like a GameStop that goes up, could go up 100% in a day, we all know that the quality isn't quite the same. It's not on the same par as same level as some of the mega cap US names or even Canadian names. But it is interesting to note. So, really it's, if an investor has a stock and it goes up 35% in a day, this chart is kind of telling us that, historically, that's not always been the worst thing. And we've seen actually a lot of the high quality US mega caps. In the past, they've gone up, they've had some 30+% single day gains. And so it signals that that's not necessarily indicative of a poor company or a low quality name. And then lastly, kind of just piggybacking off of that same sort of section, this is looking at large caps and their annualized return since inception across those single day gains. And it's kind of showing the exact same thing, is that on average, stocks that see a single day gain of, 45% and plus, typically their long-term compounder quality really starts to diminish. So for example, names that have seen a 95% single day gain at some point in their history, their compound quality or kind of annualized return has been pretty low relative to, stocks that exhibit like more normal kind of daily gains within that 0 to 35, 40% range. So that's what this research tries to show. And it tries to kind of determine a single day gain range that's, somewhat normal and can still be considered, this is probably a high quality name and not something weird that maybe should be considered more of like a trading stock or something like that.
Yeah, that's a great research. I would just add like a few comments on it. So basically, whenever investors that hold a stock that experience a big jump in a day, like most people are gonna ask themselves, is it move sustainable, or like
Right.
or people who do not own this will ask themselves, it's like, did they miss it, and do they still have room to run from there? And I think it depends on like individual like situation. Like for example, some stocks even after a big jump can still like doing pretty well, because that is most likely the name is quite being ignored by the market previously, and now it is being regraded. Or like for example, if a stock like GME experienced like a big jump in a day because of somebody on Reddit mentioned it, or on any like kind of financial media stuff, then I think that kind of gain could be like unsustainable. So it really depends on the situation. But overall, if a small cap companies that got re-rated by the market, it is usually tend to perform really well over the next few years. And I think investors tend to really underestimate how long momentum can keep going on.
So yeah, Michael, next up is what investment themes have been working and what hasn't. So I think this is kind of your section. So why don't you tell us about what's been working so far?
Sure. Okay, so this chart, like, it shows the performance of the semiconductor ETF and the software sector ETF in the US year-to-date performance. And for those that don't have the video versions right now, So the semiconductor ETFs perform like exceptionally well, up on average like 35% this year, while the software is like just up around 3%. And yeah, it's a huge and interesting divergence because back in 2021, software like as a business, as a service, was one of the most beloved names in the market. Like, high recurring revenue, low capex, strong revenue growth, high retention rates, etc. Uh, People are willing to pay like premium valuations for it, and there were tons of compounders from that space, like Adobe, Salesforce, and ServiceNow, etc. But things have changed like dramatically recently. Like the picks and the shovels of the industry, of the chips industry, is becoming like the new SaaS. Like so, basically the semiconductor ETFs were leading by a few names like Nvidia, Broadcom, AMD, etc. And it's a pretty interesting dynamics because like things could drastically change like in a short period of time. Um, and with the underperformance recently in the software sector, we think like the sector is becoming increasingly attractive more than ever. And with some like solid names trading like historically low valuations like Salesforce and Workday, um, Adobe, etc. Um, yeah, so that is pretty much my put on this thing.
Yeah.
What do you think, Chris?
Yeah, no, it's a fascinating chart, and I love like just the simplicity of this chart too. It really outlines kind of the story of 2024 so far. Like semiconductor names have been on fire, and interestingly enough, other tech names in the software space haven't been. And it's kind of like it's a weird divergence, like we've said from even previous years. I mean, some of the best performing names have been software names like Salesforce and those other types of companies, cybersecurity and things like that. And some cybersecurity names have been doing well so far, but not as well as some semi names. And it's just a really interesting theme to see, especially in a year like 2024, where the markets have been up so much. And I know a lot of these names have recovered from 2023, like Salesforce, but still to see some of them, really just trading flat is really interesting. And one thing that I've heard explaining the reason why is that, some CEOs and businesses are really just prioritizing AI spend right now. So buy as many chips and NVIDIA H100 chips as you can, focus on building out some sort of AI model, make sure that we're not falling behind in that section, and then put software spend to the wayside. So, software names maybe haven't been enjoying as much budget as they normally would have been from companies, whereas, these semiconductor names are really seeing, double the budget sort of thing as they normally would. And so that's a really interesting chart though. And yeah, no, it's certainly an interesting year, that's for sure.
Yeah, I just want to add one last point. Like in 2021, people was talking about like software is eating the world, and this
Yeah,
year again,
right.
people are talking like AI is eating software. So
Yeah.
we
That's
can just
great.
like
I love that.
yeah, we
Honestly,
can
yeah, and that's that's the great part about investing too, is the narratives never end. Just when you think you figured it out, there's always something around the corner. And so if, for investors just figuring out like software, then the next step is kind of figuring out AI and what's going on there. So yeah.
yeah, and yeah, that's the thing we could do now is like figure out like what would like next eat AI and stuff like that.
Yeah.
Um,
Got to start
um,
proactively thinking. Yeah.
right. Yeah.
Yeah.
So yeah, let's move on. So we have one more topic to cover. So basically, here's like the highlights that I have on the first uh, quarterly earnings of some of the companies that we follow, and I find it is interesting. So here I want to highlight like two names that I think does look interesting at the current levels. So the reasons like these two names look pretty interesting is although they did report solid earnings, at but the stock price still like did not reflect the solid prospect of these businesses. For example, like Propel, like companies report like really solid number, like solid loan growth and ROEs. The stock did jump big after the earnings, but like it is still only trading at like 9.8 times for PE. I think is a very mispriced name, and they could have decent performance if mainstream and institutional investors start to pay attention to the name. The other one is Well Health Technologies. This has been a beloved name in the Canadian market. The story there is highly attractive, like strong organic growth of 13%, high recurring revenue, strong free cash flow, and a healthy acquisition pipeline. And investors are always puzzled by this name that, well, basically did everything right, and yet the markets like does not reflect the proper value of these businesses. So we think like these two, if these two businesses are trading in the US, the multiples would be much higher than their current levels. Um, yeah, that's pretty much what I research on. What do you think, Chris?
Yeah, no, it's really good. Yeah, I like these two companies a lot. And I agree with everything that you're saying there for sure. I mean, yeah, if they were to trade in the US, I think valuations would be totally different. I mean, liquidity on the two names would be a lot different, which would kind of help as well. But yeah, with Propel, it's interesting. They reported earnings. They were really strong earnings, and then the stock kind of just slid over the next like month or so, and it was a pretty big fall. It was like a 20% decline or something. Um, and there's many different reasons. Maybe it was partly profit taking, or there was actually a lot of insider sales throughout that period as well. So maybe like the blackout period ended, something like that. But following that kind of decline in Propel, it popped, I think 14% in one day or 10% a day, and then climbed a little bit higher. So it's kind of building back some of that loss. And overall, I mean, there could be thoughts that, or some concerns from investors that with declining rates, that their competition is going to be increasingly tougher with larger banks that can now offer to these subprime lenders and things like that, or borrowers, sorry. But what's interesting is like Propel's business, a lot of it, almost all of it actually, is really in the US. So it's a Canadian name, but 80 some odd 80% plus of its business is in the US. So it's almost a US name in that sense. And I think that it still has a long runway for growth, especially as it enters into new markets. So that one I think has a long runway. And then Well is actually now free cash flow positive. Everything looks good. Its whole story has really changed from the 2021 kind of era, or 2022. So I think we just need to see investors kind of like take a look at that one again fundamentally. And once we start to see that happen, I think that name gets a little bit more appreciation. But yeah, I totally agree. I think these are two solid names, two really strong small caps that posted good earnings results, and definitely could see an eventual re-rating here.
Yeah, totally agree. Yeah.
That's pretty much all of our sections for today. I mean, it's been a while since we've done one of these. It's always fun to do that and talk about the markets, and there's lots going on between like both the economy and stocks. So good times to be talking about that. Is there anything that you wanted to add here, Michael, before we kind of conclude?
I have nothing to add.
No. Okay. All right. Sounds good. So, yeah, with that said, that's all for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.
3, 2, 1.